Okay, hello everyone. Thank you so much for joining us today. Appreciate you taking the time. I know everyone on this call is busy and has lots of things to do and people to talk to, so we definitely appreciate you guys taking the time to listen in today. And we've got some people joining from all across the country, New York, let's see, we got Houston, we got Mercer Island, where I went to high school. People from all over Northern California, Southern California. So this is great. We really appreciate you guys taking the time. So today we are going to be talking about a bunch of things as they relate to how the mortgage industry has responded to the pandemic. And we did a call like this about maybe 8 months ago when it was first coming to fruition, and we were seeing how the changes were happening. Fortunately, things have calmed down a little bit since then, but we'll go through a little bit of a history as to what happened initially, go through some changes that we've seen in the underwriting process, how this is impacting self-employed applicants who are probably hit the hardest by this, what the impact is if any of your clients participated in the PPP program where they have forgivable loans or forbearance on any existing mortgages or other debts that they have. What we're looking at for the future, like where do we go from here? And also we're going to have plenty of time for a Q&A at the end. So my goal is to get through all this in about 30 minutes and then to have open time for Q&A at the end. And if you have any questions, please post either in the chat or in the Q&A function. We'll do our very best to get to every question. I think we should be able to do that. So yeah, and nice to see some very familiar faces on this call. So, so thank you again for joining us. So to give us a little history, I'm going to stop sharing my screen so you can see my beautiful face. And let's just hope that my kids don't come busting in here, but that's sort of in line with talking about the pandemic. So the pandemic hit obviously roughly in March of last year. We saw a pretty immediate change from the financial markets to overcome or to try to overcome the situation where all of a sudden people were out of work and the economy sort of stopped in its tracks, and the mortgage industry had to respond to that. So what happened was banks whenever there's some sort of crisis or issue in the financial markets, banks get nervous and they start to pull back on their lending. They're not quite as aggressive as they may have been previously for certain types of applicants. So we definitely saw a pullback and tightening of underwriting guidelines. We also saw, for those of you that are more financially minded who follow the mortgage industry, mortgage-backed securities, which is how loans are sold on the secondary market, that market completely froze up for non-traditional loans. So we saw a lot of the, maybe you're familiar with bank statement loans, non-traditional financing, a lot of that just vanished, at least temporarily, when the pandemic first hit, because there was a lot of uncertainty as to whether those loans were going to perform or not. And then if you add on top of that, the government in certain areas mandating that lenders have to provide forbearance options to their mortgage holders to allow them to not pay their mortgage for a certain period of time. And you can see the financial strain that put on banks, and that really caused them to tighten even more than what they were doing before. So one of the things that the government does whenever there is some sort of financial crisis is they try to find ways to stimulate the economy. And one of the most effective tools that they have for that is indirectly to lower interest rates for mortgages. They feel that if they drop people's housing payments, they may have more disposable income to pay for other things and to keep spending happening so that there is more activity in the economy in general. So as rates dropped, they dropped to the point that they've never been before. They're as low as I've ever seen them, and I've been at this almost 20 years. And so what happened was pretty much every client who had a mortgage at that time became a viable candidate for refinancing. And we're still getting through that volume of requests, not just us, this is industry-wide. And my goal today, just to clarify, is not to make this into a sales pitch of any sort. This is really meant to be educational So I'm going to talk about the industry as a whole. You're not going to hear me talk a lot about Freedom or our team or anything like that. We may give some context, but for the most part, this is meant to be a broader conversation. So what happened was lenders got completely overwhelmed by the flood of applications. And it wasn't just lenders, it was appraisers, it was title companies, it was closing agents, notaries, if you have remote closings in some states that people are joining us from. So the whole system got completely taxed to the point where it just was not prepared. And from a lender standpoint, and appraisers and pretty much everyone else that supports this process, you can't staff up properly in anticipation of something like that. Obviously, nobody really knew what the pandemic was going to bring for us as a mortgage industry and as real estate people in general. You cannot prepare for that. And the amount of applications in some cases was 4 or 5 times normal. So imagine you have to staff up 4 or 5 times the staff that you already have. It's just completely impossible. So what happened was everything started taking longer. So appraisers were backed up to where you couldn't get an appraiser in sometimes for 3 weeks to even do the inspection, let alone produce the report. Lenders' underwriting timelines will get longer. Most lenders, if they were smart about the process like we were, will prioritize purchase transactions over refinances. But I have some industry friends who work at big retail banks who are quoting their clients 6 to 7 months to close a refinance, just a really straightforward refinance transaction. So it was a really interesting and complicated time in the mortgage industry where there was so much business flooding in, which was a great thing on one hand, but being able to uphold capacity and to be able to get through those applications became a real challenge for banks. And that sort of spilled out into all different aspects of real estate. So what did we see as far as underwriting changes during that time? We saw banks get a little more cautious with loan to value ratios. So I'll give you an example in New York City. Right now, a lot of lending options will no longer do 20% down on a jumbo loan if you're in a New York City apartment. Not every lender, but many of them have made that change because New York City temporarily, at least, did get hit a little harder than some other areas. Whereas other markets were booming like crazy, and that created some other challenges that we'll talk about. But sometimes we've seen these lower loan to value ratios persist. We also saw home equity lines disappear at some of the lenders that you would definitely think would be able to provide those. We saw guidelines tightening as far as credit scores, and some banks stopped doing cash out transactions or investment properties because those are notoriously higher risk transactions with higher rates of default nationally. So they pared back on those. Maybe they stopped doing them completely, or they priced themselves out of the market because they didn't want those loans. Whatever it may be, it was a significant and noticeable pullback. One of the hardest hit loan products, which is a popular one to higher net worth people, is interest only loans. Those have really become much more scarce than they were before. That has not fully come back yet. We're hopeful that it will come back in a more meaningful way, but it's much harder to get an interest only loan now than it was before the pandemic. One of the other issues that we are looking at is that year-to-date income for an applicant is being scrutinized much more carefully than before. So in the past, on, let's say, a Fannie Mae, Freddie Mac, government standard type of loan, not so much jumbo, but on government types of loans, they didn't typically require a profit and loss statement to see where you were at year to date. So if your income had dropped off a little bit in the current year, but you had 2 good years of tax returns, it wasn't really a big deal. Now banks are looking very closely at year-to-date income, especially because the pandemic started in 2020, and the IRS isn't even accepting filed tax returns yet for 2020. So those tax returns aren't going to be available. So if the lender is basing an income calculation for a self-employed applicant on the 2 prior years, those 2 prior years were before the pandemic, and the numbers could look very different now. So banks are heavily scrutinizing year-to-date income to see if that income has gone up or gone down. And if it's gone down, then it becomes a situation where you have to basically make a case for the underwriter, almost like you're going in front of a jury, to say, this is why I think this client's income is stable, this is what they've done, and you really have to kind of build the case. And that's something that will differentiate a really qualified lender from one that might not be able to get that transaction through. We also saw that the amount of time that documents are valid for shrunk, because banks wanted to make sure that if the client went out and had to spend a bunch of money because their business was falling off, that they still had enough money to be able to accommodate the transaction and meet the reserve requirements for how much money they had left over after closing. Same thing goes with income documents. It all has to be refreshed typically within 60 days, whereas prior to the pandemic, it was as much as 90 to 120 days. So what that means is if you have a transaction that goes longer than standard, or maybe it's standard like places in New York where 90 days is a normal closing on certain types of properties, those documents have to be refreshed. And every time they get refreshed, you might see, for example, a large deposit on a bank statement that now has to be verified, and it creates more and more paperwork. So the more times you have to go in front of an underwriter, unfortunately, the more things that they have to scrutinize. In all likelihood, the more things are going to ask that client for. And sometimes that can come up at the very tail end of the process, and clients can get frustrated because they feel like they're being asked for a lot of stuff over and over. But that's why the timelines that those documents are good for has shrunken significantly, which is causing all of this extra paperwork requirements. We've also seen, and this is more prevalent in some markets than others, but appraisers are in incredibly high demand. We have gotten some absolutely ridiculous proposals for appraisal reports as far as the timeline at which they can be completed, as well as the cost. So appraisers are not regulated in the same way that banks are. So what we've seen is it's now turned into almost like an auction of sorts, where the independent third-party appraisal management company is going out to the market of all their appraisers that are on their list to say, okay, how much are you going to charge for this report? Here's the property details, and how long is it going to take you to produce that report? And so we had a couple of them in Carmel where it's just actually, I think one of the agents from one of my infamous deals for the year where this came up is on the call today. Hello, Jennifer and team. And it became a real problem because the appraisers are price gouging, to be honest. It's typical supply and demand. They're in very high demand. There's only so many appraisers to do the job. They only have so many hours in the day. So if you're going to get an appraisal done by them, you're going to pay a significant premium. And this was a high-end property, but I believe the client who needed 2 appraisals because it was a large loan ended up paying something around $5,000 or $6,000 for appraisals. We had another situation where ironically, another property in Carmel where we literally could not get an appraiser to accept a job. It was a little bit of a complex property, a little bit further out. There weren't a lot of comps available, brand new build in the middle of the woods. So a difficult property to comp. It took us weeks to get an appraiser to even accept the job, and the price was astronomical. But it had to get done. So we found a way to get it done. So this is something that, fortunately, with the holidays coming when they did, the volume of loan applications did dip a little bit, which helped because it allowed banks to kind of catch up and catch their breath a little bit, get through some of the applications so that it wasn't flowing in faster than loans were closing. So I think this has improved a little bit, but we're still seeing appraisers with much higher prices than they had ever had before, not sticking to standard appraisal fee grids that we typically have from our appraisal management companies. That's kind of gone out the window. We'll see if that end of the business gets regulated, because I think some appraisers are definitely taking advantage of this situation and really gouging people to a certain extent. But that the jury is still out on that as far as whether we'll actually see that happen. So those are the main changes that we've seen over the last 9 months or so. One of the areas that's affected the most of all is self-employed applicants. And here's why. First of all, year-to-date income for a lot of people who are self-employed is off, and sometimes off dramatically from prior years. So an underwriter's job is to try to find a way to quantify someone's income and sort of predict the future. So typically what predicting the future means, you look back at the last 2 years of tax returns, And that's a pretty good indicator of what the person's making. And if it's moving up, that's a good sign. If it's moving down, maybe not such a good sign. If it's a smaller amount, that's generally okay. But now we're seeing significant dips in income to where the prior tax returns are no longer a reliable source of the amount of income that that person is receiving. So that can cause a major problem if you think about the logistics of the pandemic is still persisting, right? We're still seeing people who are self-employed in certain businesses, not all, but obviously in certain businesses more than others. We're seeing that their income is still being affected, obviously in 2021. So when lenders assess a standard application for a self-employed applicant, they're predominantly looking at the 2 prior years of tax returns. So if you have low income in 2020 and you have lower income in 2021, that means that until you have tax returns filed, hopefully assuming this turns around by 2022, you need 2022 taxes and 2023 taxes in order to get a standard loan approved. So that means you can't file your 2023 tax returns until 2024. So this is going to be an issue for people for several years. And that assumes that, things turn around maybe in the second half of this year for more people who are self-employed, maybe next year. But this issue is going to persist. And we'll talk about some solutions that are out there to try to help these people. But your self-employed applicants are going to get hit the hardest of anyone. It's also affecting people who rely significantly on bonus income, commission, overtime. Some companies are not allowing overtime, whereas people had become used to relying on that. So a general cutback in income can affect people even if they're not self-employed, but it's definitely affecting self-employed applicants probably the most of anyone. So the other thing that we have to be mindful of is that a lot of people who are self-employed participated in the PPP program where they got loans from the government, which are typically forgivable as long as they used it to retain employees or to add employees or whatever the requirements are. So from a bank's perspective, that is not considered income. That's a forgivable loan. That's a one-time event. It's not counted as part of your income for the year, even though people relied on that to cover their expenses. So when we look at a profit and loss statement for a client, the PPP loan is not allowed to be included. If it's included in a profit and loss statement, we have to back it out. So where it might look like they had a decent year, you back out $50,000 of PPP money, and now all of a sudden you've got a $50,000 loss, and that creates problems. So that can create issues for people that have taken these loans. Some people who own multiple businesses have taken multiple PPP loans, and some lenders we've seen have even shied away completely from certain industries where PPP loans were very predominant. We had a client who was a hotel developer. We had a really hard time getting a lender to give him a loan, even though the income was great, in part because he had some PPP loans. But even without those, we were still fine as far as our DTI ratio, and everything looked great. The guy was very strong financially. We still had an issue in part because of the industry that he was in, because most people are not traveling. So the hotel industry as a whole is getting hit, even though this gentleman had taken some pretty smart measures to make sure that his business was doing actually better during the pandemic than worse. But the choice of industry or the type of industry that a client's in, and the fact that this particular client had taken those payment protection plan loans caused issues with being able to get him approved for that larger loan. So you have to be careful if any of your clients have taken those loans to make sure that the loan originator they're working with is accounting for those properly. So, and different banks have different guidelines as far as PPP loans as well as forbearance. So this is something you also want to watch out for. What we've seen is that some clients who are very well off financially just took advantage of forbearance programs because it was offered to them. They said, well, if I don't have to make a mortgage payment for 6 months, okay, great, sign me up for that program. But what they don't realize is that if they're looking to get a new mortgage within a shorter period of time of that forbearance, that may affect their ability to get that loan. So as a general rule, the government-backed loans, Fannie Mae, Freddie Mac, FHA, things like that, you generally are okay as long as your client comes out of the forbearance program prior to closing and is current on the loan. So it's okay if a forbearance plan added principal to the end of the loan or made some sort of modification to the loan, as long as they don't consider the account to be deficient. So the client has to be current on that mortgage, even if they have a trailing balance at the end of the loan that was part of the forbearance, that's okay, but they can't be currently in default. As far as jumbo financing, we're not seeing a lot of uniformity. We're seeing, which is common for the jumbo market because every bank sort of makes their own guidelines on just about everything. So what we're seeing is that some lenders may require that the client has been out of forbearance, maybe no PPP loans if that's a requirement as well. But as far as forbearance, they may want to see that they have been completely done with any forbearance plans for at least 6 months prior to applying for that loan. So if you have a client who just electively didn't necessarily need to participate in a forbearance program, but they were offered it and accepted it, and they stopped making payments within the last 6 months, they may have affected their ability to get an aggressive jumbo mortgage. So that's something that we need to be very careful with as well. So if you know that your client has participated in something like that, you may want to tell them to mention it to the lender because it will show up eventually in the lender's due diligence. But you need to make sure that it's accounted for. So what are we looking at for the future, right? I'm sure that's what a lot of you are wondering. So we have started to see some of the products that had gone away inch back. They're coming back, but generally with more restrictive guidelines. So as far as who can actually qualify for those loans, let's say bank statement loans, for example, the requirements are stricter. The credit score requirements may be higher. They may be required to put more down or to have more money in reserves than they normally would. So the banks are not maybe, even if they're comfortable bringing some of those products back, they may be doing so only for the segment of the market that can accommodate a little bit stronger qualifications. We anticipate interest rates are going to stay low for the foreseeable future. There may be some peaks and valleys that are smaller, but in general, we're expecting them to stay in the ballpark of 2.5% to 3.5% for the foreseeable future, probably 1 to 2 years. Beyond that is anybody's guess, but in my personal opinion, I think it's going to take at least that long for us to dig out of this, because just because a vaccine starts to take hold or people start getting back to work, there's still a lot of small businesses that are going to be struggling to get back on their feet and trying to recover from the losses that they had in the past if they maybe not even kept their doors open. So I think the economy is still going to struggle to get its legs again, especially when it comes to small businesses. We may see that appraisals continue to be more expensive and take longer to get completed. That partially depends on how low rates stay and what the flow is of refinancing applications to lenders. As that picks up, appraisers get stretched more and more, and then their prices go up and their timelines get longer. So we may need to have a little bit more flexibility. I know in some markets, they're used to very fast closing, especially in the Bay Area and some other markets where, even 30 days seems like a long time. You have to be open and willing to understand that some appraisers are not going to be delivering their reports as quickly as you're used to, and that may affect your contingency and closing timelines to a certain degree. So you want to be mindful of that and hopefully, understanding of how much time your lender needs. We think, again, self-employed borrowers are going to continue to have a hard time. And that's going to persist for probably longer than any of this other stuff that we've talked about today, just because of the nature of how underwriting is done for self-employed applicants, where they're looking at the 2 prior years, whereas with the salaried applicant, they're looking at what their salary is today. So that's a continued challenge. And what that means from a mortgage industry perspective is that the lenders who can accommodate non-traditional underwriting for self-employed applicants, their market share is going to increase, and in my opinion, increase dramatically, because a lot of people who are self-employed are not going to be able to get a traditional loan from a big retail bank that is, does what I call checkbox lending, where you either fit perfectly into that tiny little box or you don't get a loan. Self-employed applicants are going to have a really hard time meeting those requirements these days, especially if they've had PPP or they've done forbearance. All these things factor in, and it's just a compounding challenge for self-employed applicants, especially for small businesses. Now, some businesses have done just fine during the pandemic, and some of them have actually flourished. So it's not necessarily across the board that this is going to be a problem, but it's definitely, the self-employed market is a big segment out there of who's applying for loans, who's buying homes. And so if that falls off, you're going to see a noticeable impact on that. So that's why lenders, and this is what, Freedom does a lot of, is non-traditional transactions. You guys may know me from the bridge loan program, which I run for Freedom. So we do a lot of this non-traditional transaction work, much of which is related to self-employed applicants and finding creative ways to get them loans when they can't get them from a traditional bank. So I think that type of lending is going to become more and more important for you to have in your arsenal of lenders that you have relationships with. Obviously, we're more than happy to be that resource for you. It could be something that can make or break a whole lot of deals for you over the next few years. So that's mainly what we wanted to talk about today. I know I'm going to check the chat really quickly. I think there were some questions. I know there were some questions about how bridge loans work. If we have time, we will definitely try to get to that. It wasn't really on the agenda for today's call. We usually do those through Compass Academy, and I think we have another one coming up in a couple of weeks. But if we have time, I'm more than happy to answer those questions. I'm going to skip them temporarily for now. So, but if you guys have any questions, please post them now, either in the chat or the Q&A, and I'll do my best to get to all of them. So first question was about bridge loans. Okay, good morning, Mark. Hello. Okay, great. Okay, so this is a somewhat related question from Houston. Hello, Stephen. Thank you for joining. Why don't we see more bridge loans in Texas? So I know I said we skip bridge loans, but this is an easy one. So Texas has very exhaustive lending laws related to homestead residence and cash out transactions, which is basically what a bridge loan is. So the guidelines that we are able to lend on in Texas specifically for a primary residence bridge loan are much more restrictive because of the lending criteria. So it's not to say that we can't do bridge loans in Texas, but the client usually has to have more equity because we have to classify properties as a rental property if they're leaving the departing residence. And that usually means a lower loan to value ratio that's typically allowed. So it takes more equity to be able to get that bridge loan done in Texas than it might in other states, specifically because of the lending criteria in Texas. Okay, so I see another question about bridge loans, which I'm going to come back to. Okay, NYC here, okay. Would love to hear what new concerns clients are raising since the pandemic has hit. There's a few. One is, and we talked about this in detail, but self-employed applicants are having a really hard time, number one. Number two, the responsiveness of lenders in general, especially with big retail banks, has gotten to the point of just being absurd. So they're not hearing back from people, or they're getting dragged out. Their transactions are taking way longer, or they're having to refresh documents over and over and over again because their closing isn't happening, partially because their lender's backed up, and then it's causing more paperwork to be requested. So it's a lot of logistical challenges that we're seeing clients, raise, but also as far as qualifying for loans and all of the different nuances that we now have to attend to that we otherwise wouldn't have to, like profit and loss statements and balance sheets for businesses that we previously may not have even had to ask for. But that's a great question. I see another question here from Barbara Ann. Hello, nice to see you. Blast from the past. Hi, Mark. What's up with appraisals? I believe most are back to in-person appraisals, but are banks still seeing desktop appraisals? So in some cases, yes. They're more common on refinances where we can get away with like a drive-by appraisal or something on the exterior. The majority of them are having to be done in person. But we can still, in some cases, make accommodations. But in general, if your client is willing to allow an appraiser in, obviously they're going to take all the standard precautions with, wearing masks and doing anything that makes the homeowner, feel comfortable. We had one situation where we got the appraisal management company to agree to literally hand their cell phone over to the owner, who then took a video of all the rooms and photos that they had asked for. So there are some accommodations being made, but for the most part, especially on a purchase transaction, there is a requirement for internal appraisals. Now that may change if the pandemic gets worse. There were some leniencies on that have somewhat subsided, but we're hopeful that those may stick around for a while or make a comeback. Jennifer, ouch on the memories. Yeah, it was a rough period, and March, April, and May were probably some of the most stressful times in the mortgage industry in a long time. It was right up there with the major financial crises that I've been through. This is my third major financial crisis, which is not really a claim to fame. It's not something I'm proud of, but you start to see some similarities from one to the next. And yeah, that was definitely a tough one. Okay, so Barbara Ann again, the last appraisal I had in Brooklyn was a mess. The guy showed up an hour late without notice and then took over a week to issue his report. Thankfully, to appraise the contract price. More of a headache than ever. Yeah, you're going to see that. Appraisers are backed up, so what's happening is their schedules are getting squished. They're trying to fit in as many inspections as they possibly can, and that usually sometimes will lead to them showing up late to their appointment. And then what they'll do in a lot of cases is they'll go out, spend a whole day on the road, and they'll go and inspect, 5 to 10 properties. And now they have 5 to 10 reports to draw up. And that can sometimes delay how long it takes for them to draw up the report. We haven't seen this quite as much in New York as we have in California and some other markets, where appraisers are so backed up that reports are taking sometimes like a month. New York hasn't been hit quite that hard because the purchase market was a little bit slower, but in some segments of the market, you were getting just crushed with refinances, and also the purchase market was very, very hot. The other challenge that we didn't touch on previously, but I think it's relevant now, is that in some areas, you're seeing values go up or down pretty sharply and fairly quickly. So that creates a problem for appraisers where they're trying to find comps that support a price. And if those prior comps were significantly higher or significantly lower 2 or 3 months ago, that creates a challenge for an appraiser. How do you appraise that? What's the predominant value? If the comps show a lower value, how do you justify a higher value? It can't just be that the market is increasing. They have to show comps. That's one of the inherent problems with appraisals, is that it's based on what's sold in the past, not what's selling right now. So unless it's actually closed, which is usually at least, let's say 30 days, if not 60 or 90 days from the time it went into escrow or contract, you have a lag time there. So it can cause a problem with appraisal. We haven't seen it too much because fortunately there's been enough comps to be able to support values for the most part. But in some markets, we're definitely seeing this where maybe the market is so hot that people are having to bid the price up. And if you're putting 20% down and you're bidding 100,000 over asking or more, you may have a situation there because you're having to bid up so much to be competitive with other offers, but then you're squeezing yourself because if the appraisal doesn't support that higher price, and maybe the price was set based on prior comps and you're now bidding it up, you're creating more of a challenge for that appraiser to support the value. So we have seen in certain markets more than others where appraisers are having a hard time determining whether they should go high or low with an appraisal report. So Barbara, and I appreciate you asking those questions because I think that was relevant. Do you think, okay, this is a question from Michael. Do you think most self-employed people will need non-QM loans? I would say a good portion of them, hard to say most, because I think some self-employed applicants are still doing just fine in their businesses. But some that you would think, would be just fine are having some difficulty. I'm doing a loan right now for a drummer of one of the most famous 80s rock bands, and he's not touring, so his income has dropped substantially. So even well-to-do people are struggling with this. I think non-QM is definitely going to play a major role in the rebuilding of the economy, if you look in the bigger picture, and also just in allowing self-employed applicants on a larger scale to be able to purchase. So we're definitely already seeing, and will continue to see probably for another 2 to 3 years, that the non-QM market is going to play a more dominant role, specifically for self-employed applicants. Will most of them need? Hard to say what percentage of them have businesses that are falling off versus ones that are doing well. But I would say most small businesses, for the most part, on average, are probably having a harder time than someone who owns a business that's a little larger, a little more established, where maybe they have, other resources that small businesses don't have. But a great question. Can you help us understand a little bit more? This is from Jennifer. Hi, Jennifer. How are you? Help us understand a bit more how a PPP loan or other unsecured promissory note affects the DTI. Monthly payments come straight off the DTI or entire note off the annual income. So most PPP loans, not all, but most of them are actually forgivable. So in the event that there is an actual payment on it, we do have to factor it into the debt to income ratio. If it's a legitimate ongoing payment that's going to persist for a period of time, if it's one that is designated as one that is likely to be forgiven, we can generally ignore it, especially if there are no required payments at that time. But where it affects you the most is if a client needs that money that they got from the PPP loan to be able to show a profit and loss statement that isn't a loss. That's where it becomes a problem, where if the PPP loan was actually supporting the business and that the business would have been underwater for that particular period of time without the PPP loan, which is, to be honest, why most people took them, that can create a problem because it's not going to be included by a lender as income. So if that was something that they were relying on, that will show up in the documents and it can affect how your debt to income ratio is calculated because it reduces the actual income if you're not counting that as income on a loan application. So great question. Thank you, Jennifer. Nice to see you. You mentioned tax returns for 2020 not being accepted yet. Can you clarify? From Melanie. Thank you, Melanie. So the IRS actually does not accept tax returns until, I believe, mid-February. So if you have a client and I have one right now, where they have their tax returns prepared, but they physically cannot file them with the IRS until February. So if you're trying to use 2020 income on a loan application, for the most part, you can't. Now, we've been able to find some creative ways where we can, for transactions that are just starting now, where we will have a filed tax return prior to closing, we've been able to accommodate those. So it's a little bit of creative way to work around that. But the IRS physically will not allow you to submit tax returns until a certain date of February. So that's why. Okay, great. Thank you very much. You're welcome. Okay, so I think that is most of the questions. I'll still keep an eye on them. I know there were some questions about bridge loans. Since this is a Compass call, I figured, if we've got some time and you guys want to stick around, I'd be happy to talk about that. So, and I think we do have a little bit more time. So anyone who wants to stick around and learn about bridge loans, why not? Let's do it. Thank you, Elizabeth. Nice to see you as well. Thank you, everyone, for all the thank you messages. So for those of you who want to learn about bridge loans, here we go. So, and I wasn't prepared, so I'm just going to go off the fly. But I've been talking about these bridge loans for so many years now that I could talk about this for days. But we've got about maybe 10 minutes or so left, so we'll use up that time. So the bridge loan program with Compass, a really effective tool. We've had a lot of inquiries, over 1,000 inquiries from clients and agents, and there's been a lot of demand. The main purpose of it is to basically avoid sales contingencies. So if you have a client who is coming in and saying, God, I really want to buy a new home, but I need to sell my home first, and you know that in your market, which is pretty much every market in the country right now, if you go in with a sale contingent offer, you're not going to get an accepted offer. It's just not going to happen. In some cases, you won't even get a phone call back. So the bridge loan allows you to be able to cash equity out of your current home in one capacity or another. We have different ways to accomplish that in order to fund the down payment on the new property. And so in most cases, not all, depending on how much equity somebody has, you're usually combining the bridge loan with a purchase loan as well. So the bridge loan gets you access to equity in the current home to pull out the down payment, which you then use on the purchase transaction for the property that you're purchasing. So that's the main purpose of it. We have many other uses for it. We have some great niches associated with that program, which we do for all types of lending, but specifically for bridge loans, one of the most common ones that we see very often is that you have clients who have enough income to qualify to buy the new home, but they don't have enough income to qualify to carry both. So maybe they were pre-approved by another lender before they were introduced to this program, and they have a pre-approval, but that pre-approval is contingent upon selling first, which doesn't do you any good if you can't get them an accepted offer on those terms. So the bridge loan is a way to overcome that issue, if they qualify, of course. And that's basically the purpose of it, is to be able to pull the equity out of the current home. Even while it's listed for sale, we can do that and be able to close that transaction that they're trying to buy without having to close on the sale of their property first. So with these situations where you have clients that have income to support the property they're buying, but they don't have enough income to qualify carrying both properties at the same time, which is very common, probably 50% of the transactions we come across have that situation. We have a niche where we can completely ignore the departing residents in our debt to income ratio calculation. So let's say you have $1 million home and you've just leveraged it with a bridge loan up to, I don't know, 700,000, let's just say, and you have your taxes and insurance and maybe HOA fees. We can completely ignore that $700,000 debt and all the payments on that property as long as they have the property listed on the MLS or any equivalent. So it's a really effective tool. We use that niche over and over and over again. And it's a really unique one that you're not going to find from most lenders. And all we require is that the property is listed. It doesn't have to be an escrow or contract. You don't have to be past contingencies or anything like that, which is a requirement of some other programs that are similar. This one just has to be listed. Doesn't even have to have pictures on the listing, but as long as you do a Google search and it shows up. Unfortunately, coming soon usually doesn't do the trick. It has to be on the MLS, but we can sometimes fight that if need be, if it's a strong client. One of the other niches that we have is that we can convert money in the bank into qualifying income. So I'll give you an example. So let's say you have a retiree who has maybe $1 million, $2 million saved up over their lifetime in an IRA or a 401k or whatever it may be, but they're on a fixed income. They're on Social Security, maybe a pension, a few $1,000s a month, and they're just basically living off of their IRAs, which is sort of the whole design of retirement planning. But those people really struggle to get mortgages approved because they don't have a lot of traditional income. So this program, which we call asset depletion, allows us to convert those assets that are in the bank into usable income on a loan application, even though it doesn't show up as income on their tax returns. So that client who has, let's say, $2 million in an IRA and they're 75, 80 years old, not working anymore, they're able to qualify for a pretty substantial amount of financing which is important when you're trying to bridge. So even if you have, a client who owns their current home free and clear, but they don't want to liquidate their IRAs, which would have significant tax implications, we can accommodate that client. Obviously we'll have to run the numbers to see how much of a loan they can qualify for, but it's another really, really great niche. So those are a couple of the common uses. We don't have a requirement on what your client uses the money for. So one of the other nice niches is if you have a client who is looking to do a major renovation on the new home, and they don't want to take a construction loan on the purchase because, timing is really difficult on construction loans. And you also have to answer to the lender whenever you want to pay your contractor. We can actually cash out, if there's enough equity to do so, we can cash out enough money to do a down payment and then also fund renovation costs. And we don't have a limit on the loan amount. The rates are really competitive. I think our average so far since we started the program is around 4.25%, 4.1, 4.2. Points generally are anywhere between 0 and 2. And what we really pride ourselves on is taking a client situation and finding the most cost-effective solution for them to get from point A to point B. And we have 4 different types of programs that we use, or different strategies or types of loans or structures that we use, and they're all right for different clients in different situations. They all have different terms, so you'll see different interest rates, you'll see different points on some of them. So that's why it's not really a one-size-fits-all type of scenario. But if you have a client who's interested in this program and wants to find out more, what they can do is they go to our website, which you can find through the Compass BLS landing page, or many of you have your own Bridge Loan Services page with your own branding on it. So if you click through to Freedom Mortgage, you'll get to our website. There's a page called Inquire, where your client would fill out a form. It takes them all 5 minutes. We don't run a credit report or anything like that. We just ask them very general information about how much equity they have in their current home, what they're looking to buy, some very top level financial details, and just asking them, like, for example, what's the general classification of your credit? Is it excellent? Is it poor? Is it okay? And so we take all that information, put together an analysis, and usually within one business day, we're on the phone, 1 business day of receipt of that online inquiry form submission. We're on the phone with your client outlining specific options. And then if they want to proceed, we would then send them a list of the documents to get them either pre-approved or to start the loan application. So that's the general process. I'm not sure if there's specific questions. I see some that have come in. So I'm going to go back to the Q&A here. Bear with me just a second. Okay. Thank you, Mark. Great info. You're welcome. Taylor from NYC. Okay. Regarding the higher down payment requirements in NYC you mentioned, this is a non-bridge question. That's fine. How do you determine the boundaries by zip code, county, etc.? If my buyer knows ahead of time the down payment in a neighborhood X may be higher than neighborhood Y, then this would be helpful for them to know in advance. So, okay. So great question. Banks don't go neighborhood by neighborhood. So it's really county driven. So anything in the 5 boroughs of New York City right now, if you have a client putting 20% down on a jumbo loan, this does not apply to government-backed loans that are right now on apartments or any single family dwelling in New York City. It's a high balance area or high cost area. So the maximum loan amount on a Fannie Mae or similar loan is $822,000. So if you're talking about a loan amount above that, you need to check with the lender to see if they're going to allow for anything less than 25% down. It's different. What's getting hit more is apartments, which I know in New York City is predominant. Most of the properties are going to be apartments of some sort, either co-op or condo. But if your client is putting less than 25% down, you need to check with their lender to make sure that they can still accommodate that. This is still evolving, and I think the New York City market is really making a strong comeback already. We've definitely seen it as far as the number of inquiries and new accepted offers with our New York clients just in the first few weeks of the year, which for New York, for those of you who are calling in from New York, know that this is a market that, is very seasonal, and usually January is quite slow, and really even February. We're seeing a lot of activity this January compared to most years, but the pandemic really threw off the seasonality of just about every market. New York is no exception there. But as far as your question is concerned, it's all 5 boroughs. Anything that's a jumbo loan with 20% down, you need to ask the question. And with a lender like Freedom, and again, not trying to make this a sales pitch, but just so you know why certain lenders are different than others, if you're going to a retail bank, let's say a Chase, a Citibank, Wells Fargo, Bank of America, whatever it is, they have one set of guidelines. And so they should be able to tell you quickly and easily if they can do 20% down or not on a jumbo loan. But they either can do it or not. It's black or white, right? So, but with a lender like us, where we have multiple sources of funding, where we're both a direct lender and a mortgage broker, we have some lenders that don't have that requirement, and 20% down is fine, or maybe even 10% down is fine. We have HELOC lenders that will go up to 95% financing, which is another tool we use for bridge loans as well. So it's really case by case. If they want to call us, we'd be happy to help them sort through that. And understand which sources are available and which ones are not. But sometimes that can affect the rate. So if a client says, you know what, 20% is all I have to put down, okay, then that just means we may need to structure the loan in a way that will allow for that, but it might not be the best rate option out there. So they may have to give and take a little bit. But that's a really great question. Thank you. Carolyn, hello, Carolyn. Thank you for your question. I have a retired gentleman whose only income is from investments. He will need a bridge to pay all cash for a condo in Rossmore, a retirement community. Will he have trouble getting one? He has over 1.5 million in equity on his existing home. So this is a perfect example of the asset depletion loans being a great solution. So assuming he doesn't have sufficient investment income, meaning capital gains, dividend interest income showing up on his tax returns, he would be a perfect candidate for that type of loan. And we can do asset depletion on bridge loans or any other type of loan in particular. We've done them on just standard purchases, bridge loans. It doesn't really matter what type of transaction it is. So that client, if you want to follow up, Carolyn, after the call, we can definitely explore that. Again, if you can submit online with the online inquiry form, that's probably the most effective and quick way for him to get some information. But that's the type of transaction where you need something non-traditional, where, again, we're talking about how non-QM is becoming a more prominent part of the market because you have more people like that. You have people in the Bay Area where, you know, they just sold their company to Google or Apple or, you know, and now all of a sudden when you sell your company, you have a lot of money in the bank, but you don't have a job anymore because you just sold your company, right? And so unless they're retaining you, you may be out of work for a while and probably want to enjoy yourself, but you may also want to buy a home. So these types of loans are great to fill in those gaps of people that you think would have no difficulty getting financing, but because of lack of income, they do. So this is a great example, Carolyn, thank you for asking that question, of how the asset depletion loans in particular can be really helpful. Will you be sharing this recording on Compass Academy or anywhere we can share with agents at Compass? Yeah, so I'll post my contact information at the end. We are recording this session, so we can send out a link. I can't speak on Compass's behalf if they're going to post it on Compass Academy. I would love it if they would. And we have some Compass management people on the call today, so hopefully they're listening and be willing to do that. Because I'm not part of Compass per se, I can't post it myself, but we'll definitely inquire about whether that would be possible. But if you want to follow up with us afterwards, we can certainly send you a link. Okay. Mark and his team have been doing an awesome job for us on all loans, not just bridge loans. Thank you, Mark and team. Thank you for the plug. Much appreciated. Can you please email the link to us? We will, yes. Okay, question from Janice. If someone is on short-term disability, can you count their income or do you have to wait until they're back at work? It depends. If you're asking specifically about maternity leave, which is the more common one where people are out on short-term leave, we generally can use that. It depends on how long it continues and if there's going to be a gap of unpaid leave afterwards. So that type of situation typically needs to be addressed as a one-off. where we would inquire about, how long the disability income is going to be paid, what percentage of the salary, and in some cases, if a client is going to return to work full time before the first full payment is due, then we don't even have to worry about it. We can qualify them on their salary. So as you might know, the first payment on a loan is usually at least 30 days, if not maybe as much as 60 days after the closing, because you prepay your first month of interest payments at the closing table, and mortgages get paid in arrears. So you accrue interest throughout the month, and then you pay it at the end of the month. And so what happens is, in some cases, you'll see that the first payment isn't due for 45 or 60 days after the actual closing takes place. And if that client is going back to work, let's say it's a maternity leave situation, they're going back to work before that first full payment, and we can verify that they're going back at either full salary or a partial salary, and the partial salary is enough to qualify, then we can definitely use that income. And disability income in general, in some cases, is non-taxable. It depends on the type of disability. Some government pension disabilities and things like that are non-taxable, in which case we can actually use 125% of the face value. But if it's a maternity leave where they're on temporary disability and going back to work, we would explore when they're going back to work relative to when they want to close and try to figure out if there's a way to use that income. If the short-term disability is going to continue for a long time after closing, it does get definitely more difficult to do that and use that income to qualify. But we would look at some of the non-traditional ways that we might be able to still get that person approved, whether it be asset depletion or other types of solutions that we provide. So great question. Caramba. Oh, really informative. Thanks, Mark. You're welcome. So I think that's pretty much all of the questions. I am going to reshare my screen so that you guys have our full contact information here. In case you want to connect, our Instagram account is a really fun way to stay connected, at the Bridge Loan Guy. Facebook, you have our team email address here, phone numbers for both New York and Los Angeles. We obviously support all markets for Compass around the country. I'm personally licensed in about 21 states now and growing, and so we can accommodate your clients almost anywhere. So whether it be bridge financing or anything else, or, we always say, don't assume a deal is not doable until you've spoken with us because of all these creative niche products that we have. So, and I know I'm eating my own words about not making this a sales pitch at this point, but we're going on the fly here. But yeah, you can definitely reach out to us. We have a great team of people, really dedicated. We got some nice comments on the chat line there about the work that we do, and we really take pride in being able to figure out difficult situations. I think any lender can do the easy transactions. Where a lender can really add value to you is in squeezing out maybe a couple extra deals a year, 2-3 extra deals a year on clients that can't get approval for traditional financing or that need bridge financing in order to be able to make an offer that's not sale contingent or things like that. Incrementally, we can add to your book of business. And I think that's where a true partner really comes in, and that's where we can be really valuable for you. So we definitely appreciate you guys taking the time, and we definitely look forward to connecting. So thank you so much. I'm going to leave this up. I will stop sharing my video and mute myself, but if you want to take down our contact information, reach out to us with any specific questions you have, any scenarios. We are here to help, and Compass has been a great partner for us through the Bridge Loan Services program. So we are more than dedicated to what you guys are doing, and really feel like a partnership is really brewing here. So we appreciate you guys taking the time during your busy schedules. And if you have any follow-up questions, please feel free to reach out. Okay, have a great day, and thanks again.